In 2002, one Canadian dollar bought roughly 65 cents US. By 2011, it briefly bought more than $1. Today, it hovers in the mid-70s after 2 decades of what everyone calls stability. No hyperinflation, no IMF bailouts, no currency pegs snapping overnight. The banks still clear transactions, mortgages still get approved. The dollar didn't die loudly, it thinned. The official story is simple. The dollar weakened because of cycles, oil prices, U.S. interest rates, global shocks. But fundamentally, it's fine. That story feels reasonable because nothing dramatic happened. You can still buy groceries. The currency works everywhere you need it to work. Tap to Pay clears instantly. Shelves stay full. Every signal from every institution says, "We are managing this." But Canadians feel poorer every year in ways that don't match official inflation or GDP growth. Imported goods creep upward. Housing absorbs more income. Real wages stall. The unease isn't panic, it's the slow recognition that something structural has changed, and that the change happened before most people realized they needed to react. The contradiction is this: Canada did almost everything it was told would protect a currency. Independent central banking, conservative fiscal language, regulated finance, yet the dollar has quietly lost ground for 2 decades. Not in a crisis, in a managed, orderly decline that transferred costs without ever declaring them. The damage is already done because the dollar's decline isn't a market failure. It's the footprint of a system designed to pull future value forward to stabilize the present and never replace it. The Canadian economic model was built around avoiding extremes. A resource exporter with a small population, it leaned on trade, stable institutions, and incremental growth. The dollar was never meant to be flashy. It was meant to be trustworthy. A medium of exchange anchored by predictable policy, conservative banks, and a social contract that balanced wages, public services, and asset ownership. For decades, this worked because extraction was paired with renewal. Energy revenues funded infrastructure. Immigration expanded the labor base without overwhelming capital formation. Housing functioned as shelter first and investment second. Credit expanded alongside productivity. When shocks arrived, the adjustment was shared across wages, prices, and profits. Crucially, the currency reflected this balance. A weaker dollar helped exporters. A stronger one rewarded consumers. Neither state dominated for long because the underlying economy regenerated real value. Growth came from doing more, not bidding up what already existed. This is why the model felt fair. Even when inequality existed, mobility remained plausible. Home ownership was accessible. Pensions were funded. The currency represented something real, the productive capacity of a functioning society. If that assumption, future renewal, was the load-bearing beam. Once it cracked, the dollar stopped representing productivity and started representing time borrowed from it. The shift did not begin with recklessness. It began with risk avoidance. After the early 2000s slowdown and again after 2008, housing became the shock absorber. Falling interest rates protected homeowners and construction jobs. Rising prices substituted for wage growth. Households learned the lesson. Leverage was safer than labor. The dollar increasingly circulated through mortgages rather than production, anchoring consumption to asset appreciation instead of income. This wasn't irrational. For someone who bought in 2003 or 2009, housing delivered returns that wages never could. Banks were eager. The government signaled support. The incentive was clear. The safest path to wealth was securing a claim on something scarce, not building something new. But this created a distortion. Money that might have funded export capacity, technology development, or business formation instead flowed into bidding up existing homes. Capital circulated internally, raising nominal values without expanding productive capacity. Growth appeared healthy because transaction volumes were high. Underneath, the economy was shifting from creation to extraction. Canadian banks, insulated from the 2008 collapse, doubled down on the safest returns, residential lending. Capital flowed into mortgages because they were government backstopped, politically protected, and socially normalized. This crowded out riskier investment in innovation and productivity. Credit growth outpaced productive growth, but it looked healthy because default stayed low, propped up by ever lower rates. The system learned to survive by expanding claims faster than capacity. Rather than confront stagnation, policy favored smoothing, and deficits became structural but were framed as temporary. Public spending stabilized demand without demanding reform. The currency absorbed the pressure. A softer dollar preserved competitiveness without forcing internal change. This traded purchasing power for calm. It allowed the economy to avoid hard choices by quietly taxing everyone who held Canadian dollars. Population growth accelerated to sustain housing demand, tax bases, and public services. More people meant more GDP, but capital investment lagged. More people chased the same stock of homes, infrastructure, and productivity. Nominal GDP rose, GDP per capita stalled. The dollar weakened not because Canada produced less in aggregate, but because it produced less per person while issuing claims as if it hadn't. A basement apartment in Brampton tells the story clearly. Built as single-family housing decades ago, subdivided to accommodate newcomers, it now houses 2 or 3 people where one family once lived. Rents are high relative to local wages. The landlord depends on the income to service mortgage debt. The tenants work service jobs, saving little, unable to access home ownership themselves. The municipality struggles to expand infrastructure fast enough. No one in this arrangement is irrational. Everyone is responding to incentives. The system continues. And the currency weakens because productive capacity per person has not kept pace with the claims being issued. Resource revenues once renewed the system. Over time, they became a volatility buffer instead. High prices masked structural decay, low prices justified stimulus. Either way, diversification stalled. The currency became a pressure valve for commodity cycles rather than a signal to rebalance the economy. Firms learned that the highest returns came from sectors insulated from global competition: real estate, finance, telecommunications, banking. Sectors where regulatory protection or geographic captivity ensured stable margins. The easiest money was domestic. The riskiest was productive. Each layer reinforced the next. The more the system relied on extraction of housing equity, future taxes, future productivity, the more it needed a compliant currency. Reversal meant immediate pain. Continuation meant quiet erosion. The choice was made implicitly, repeatedly, across every major institution. Stability now, costs later. Spread across everyone who couldn't hedge. By now, the pattern is unmistakable. When growth slows, rates fall. When rates fall, housing rises. When housing rises, credit expands. When credit expands without matching productivity, the dollar weakens. And when the dollar weakens, imported inflation erodes real incomes, just enough to avoid revolt, never enough to force reform. Institutionally, this makes sense. Banks protect balance sheets, governments protect employment, homeowners protect equity, pension systems protect nominal returns. Every actor behaves rationally within their mandate. The currency's decline is not a bug, it's the emergent property of risk avoidance at scale. Attempts to fix it worsen the loop. Tightening monetary policy threatens housing and banks, so it's brief and shallow. Fiscal stimulus props up demand, but not supply. Industrial strategies announce renewal, but fund slowly. Each intervention leans on the same lever, issuing more claims on the future to stabilize the present. This is why comparisons to Japan resonate, not because outcomes will match, but because the logic does. Japan traded volatility for stagnation and preserved social order by freezing structures in place. The yen weakened over decades. Society remained orderly, polite, and functional, and poorer relative to what its post-war trajectory promised. Canada is following a similar script. Instead of preserving industrial incumbents, it preserves housing incumbents. The outcome rhymes: stability maintained by preventing the market from reallocating capital toward renewal. The statistic that reframes everything: over the past decade, Canada's real GDP per capita growth has been near zero. Household debt ratios sit near record highs. The currency has steadily weakened. These are not signs of mismanagement. They are signs of a system optimized to avoid disruption by distributing costs invisibly. A currency cannot remain strong when claims grow faster than capacity indefinitely. The system is not failing, it is harvesting. At this stage, every major actor is boxed in. Policymakers face a trilemma: defend the currency, defend housing, or defend growth. They can choose two briefly, never all three. Higher interest rates strengthen the dollar but fracture households carrying debt and threaten banks. Lower rates protect balance sheets but weaken purchasing power. Structural reform takes time the system has already borrowed. Voters are trapped by exposure. A majority of household wealth is tied to housing. Even those who feel poorer depend on rising asset values to stay solvent. Demands for affordability collide with fear of loss. The political coalition that benefits from high prices is larger and more organized than the coalition harmed by them. There is a municipal council meeting in a mid-sized Ontario city. A proposal to rezone single-family neighborhoods for multiplexes. Younger residents argue for density and affordability. Homeowners argue for neighborhood character. Both sides are correct within their frame. The zoning stays, supply stays constrained, prices stay elevated, the people who need housing leave or accept worse conditions. The currency continues weakening because the productive base per capita continues stalling. Capital is trapped by incentives. Productive investment carries political risk and long payback periods. Asset lending carries implicit government guarantees and short-term returns. Money flows where it is safest, not where it is most renewing. The result is suffocation. No crisis dramatic enough to force a reset. No growth strong enough to escape the trap. The dollar absorbs the pressure because it is the least visible lever and the most regressive. Continuation does not mean collapse, it means adaptation along fault lines. Those with assets hedge. They hold foreign currency, foreign equities, or hard assets. They treat the Canadian dollar as transactional, not preservational. This is not pessimism, it is rational positioning. Those without assets feel the grind. Wages lag import prices, savings decay in real terms. Mobility narrows. A young worker faces a choice: stay and accept diminished expectations, or leave for higher purchasing power elsewhere. The brain drain is not dramatic. It is a steady trickle of talent that never returns. There's a graduate in Vancouver who spent 4 years studying engineering. Her salary is competitive locally. Her rent is not. She watches her peers in Seattle earn 40% more in USD while paying similar rent. She does the math. She applies, she leaves. The system records this as emigration. It does not record it as extraction. Her education funded by Canadian taxpayers, her productive years captured elsewhere. Some stay and adjust expectations downward: smaller homes, delayed families, permanent debt, careers that plateau, retirement plans revised, travel constrained. None of this is crisis. It is simply a generation calibrating to the economy they inherited rather than the one they were promised. The country remains orderly, polite, functional. This is not Argentina. This is a wealthy, stable democracy managing its decline so competently that most people do not recognize it as decline, just a vague sense that things are harder than they should be. Geographically, opportunity concentrates further. Toronto and Vancouver continue attracting capital and talent. Peripheral regions stagnate. The national economy posts modest GDP growth. The regional economy hollows out. The system survives by narrowing ambition. Firms stop trying to compete globally and focus on domestic rent-seeking. Workers stop expecting wage growth. Governments stop promising transformation and settle for management. Everyone adjusts their expectations to match the constraints they face. Politically, this produces stasis. Parties alternate in power, but policy does not shift materially because the room to maneuver is gone. Incremental tweaks replace structural change. The language of reform persists: innovation, productivity, competitiveness. But the actions do not follow because the actions would destabilize the constituencies that keep the system running. The extraction continues because stopping it would require accepting losses that no political coalition is willing to bear. Housing prices cannot fall significantly without bankrupting households. Debt cannot contract without collapsing demand. Rates cannot rise sustainably without fracturing the financial system. Every path forward involves pain the system has been designed to avoid. And so it continues on the path of least resistance, managing decline through currency adjustment and expectation recalibration. This is the steady state, not crisis, not recovery, managed stasis. The future is already visible in the present. It is visible in the household that earns $150,000 combined and cannot afford a detached home in the city where they grew up. It is visible in the pension fund reallocating toward foreign assets because domestic returns cannot meet obligations. It is visible in the skilled worker who stays because of family but knows their purchasing power will continue eroding. It is visible in the retiree who owns their home outright but watches grocery and medication costs rise faster than their fixed income. None of these are crises, they are adjustments. The system continues because it has successfully distributed the costs across enough people in small enough increments that collective action never coalesces. The wealthy hedge, the middle class endures, the young leave or lower expectations. Each group adapts individually. The structure remains. The dollar's decline is not a failure of planning. It is the success of a particular kind of planning, one that prioritizes stability over growth, continuity over renewal, consensus over correction. The currency is doing exactly what it was implicitly tasked to do: absorb the adjustment that politics and institutions refuse to impose directly. This is why the common narrative that Canada just needs better policy or smarter leaders misses the point. The system is not drifting by accident. It is executing its implicit mandate: preserve the present by borrowing from the future. The dollar is the instrument through which that borrowing happens. The only question left is positional. Are you holding the currency or are you holding the assets? Are you earning in CAD and spending in CAD? Or are you hedging abroad? Are you young enough to leave or tied down by mortgages, family, and sunk costs? The system does not care who deserves what. It allocates costs and benefits according to exposure and mobility. Those who understand this early enough can position themselves accordingly. Those who expect fairness or eventual policy correction will continue waiting for a reset that never comes, because the system is not broken. It is working exactly as designed. The Canadian dollar is not dying from neglect or mismanagement. It is being used systematically and deliberately as a tool to avoid confronting structural decay. It will continue weakening, not in a crash, but in a trend, because every alternative requires someone powerful to accept visible losses. And the system has been optimized for 2 decades to ensure that never happens. What comes next is more of the same: a stable, orderly economy that continues by extracting future value to fund present calm. Recovery is not the objective. Continuation is. The currency reflects that choice, and if you are holding it, you are the one paying for it.